We don't need to tell you this, but we're going to anyway. Mortgage rates more than doubled last year. They could be headed even higher this year. Depends on the bond market. So if you're a potential home buyer out there, do you kind of get used to this new normal? Let's bring in CNBC senior real estate correspondent Diana Olick. Diana, I guess what is the new normal?
Well, the new normal is higher rates. The mortgage rates did drop back in November and early December, but they ended 2022 on a high note. The average rate on the 30-year fixed had swung nearly a full percentage point lower from around 7.25% to 6.25%, but by New Year's Eve, it was back up over 6.5% again. So for the buyer of a median-priced home, today's mortgage rate translates into a monthly payment of about $2,100 without taxes or insurance, which is a 63% increase from last year. Now, on the bright side, there is much more housing supply, 47% more than a year ago at the end of November. Still slightly below the historical average, but it is translating into a slower, less competitive market. Now, the home builders have been pulling back, and you see the home building ETF is down around 24% year over year, but off the much sharper lows from last June when rates first went over 7%. Okay, so the big question you ask, what about the spring market, which isn't all that far away? Are buyers sufficiently used to higher rates, and will lower prices now entice them back into the market? Prices have fallen 2.5% since June, and while they are still higher than they were a year ago, that may not be the case come spring. So, Brian, again, you ask, is it a new normal? Maybe once we get used to the sixes, we get into the sevens. I'm not so sure.
Where do we stand in sellers coming down in price? I got to imagine there's two types of home sellers. You got the people that have lived in a home 15, 20 years. They got a lot of equity. They can come down in price, still sell it for a price they're happy with. Then you got people that bought a house last 2, 3, 4 years who may not have, maybe took an equity line to put in a new kitchen. They can't lower their price.
Right, and it's not just do they want to lower the price. It's you've been in that house a long time, you've refied a lot, and you probably have a rate around 2.75%. So you may have a lot of equity. You want to move and buy somewhere else. Do you want to trade your 3% mortgage for a 6.5% mortgage rate? Probably not. But if prices start to come down and buyers start to come out again and start maybe bidding a little bit, you know, it's back and forth. It's a question of how desperate are you to sell? Do you need to sell? Do you wait it out? We are hoping more sellers come out to the market because right now what's on the market is sitting a long time.
There's like it's like infested with scorpions or something like that. Yeah, Diana Olick, thank you very much. There's a reason. My apartment is infested with koalas. It's the cutest infestation ever. Mitch Hedberg. Karen, you brought along a chart?
I did. No, I was just thinking about mortgage rates. And if we look back at the 30-year mortgages over the last 50 years, we think we have the chart. There it is. So, you know, we have this idea that mortgages have just gone berserk. And in fact, if you look at the average over those 50 years, it's actually like 7.75%, which is meaningfully higher than where we are now. So I think we need to reach an equilibrium where it just stays kind of around here for a while, and then we'll start to see more transactions. So I'm not so bearish on the housing market. I think it'll take some time, but... Not so
bearish guy, Dami, is not bullish. Are you bullish on the housing market?
Yeah, it's sort of, because it's supply. It's like the energy market. It's a supply thing. It's just there's no real supply out there. And if you want to look at DHI quickly. This was a stock this time last year, effectively, $108 stock, all-time high. You'd think, oh, this thing must be cut in half. No, it's trading $90. It's actually trading really well. The home builder stocks have priced so much nonsense in that I think they're worth looking at here.
The fly in the ointment for me on all this are just where rates are going. And I'm not going to tell you that they're going to 5% anytime soon, but I'm not sure they're going to 3% anytime soon either. What Kuroda did, BOJ, yield curve targeting is over. European yields are near their highs. If the rest of the world's rates are going higher, are our rates going to go down independent of what's going on with the economy? I'm not sure.